annual Laurentian Bank's Investor Conference. For those of you who have just joined, my name is Yash Sankpal. I am the REIT analyst here at Laurentian Bank, and Ms. Nishita Mehta will be helping me in the background to moderate this session. Before we start, some housekeeping items. Please ensure that your microphone is on mute and your camera is turned off. Also make sure that your name appears on the screen so we can properly address any questions you may have. We request that you hold your questions until the discussion is over. You will get the time at the end to ask questions. Please use the raise a hand feature if you have any questions. If you experience any technical issues when it is your turn to speak, please communicate that in the chat. If you would like to download the corporate presentation, you can access them from the virtual briefcase during and after the presentation. You can also explore more information using the icons on the bottom right of the screen. Okay, with that out of the way, now let's move to the main part of the meeting. In this panel, we are going to chat with executives of 3 apartment REITs. First, let me introduce our guest panelists here. With us today are Mr. John Bailey, CEO of BSR REIT, Mr. Curt Miller, CFO of InterRent REIT, and Mr. Phil Fraser, CEO of Killam REIT. Main Street Equity was supposed to join us on the panel, but because CEO Bob Dillon is on the board of CMHC, he cannot participate on such panels. So it's only 4 of us. With that, I'm going to start asking each of the panelists to give us a 2-minute introduction of their company, and then we'll go into specific questions. May I start with John Bailey, please?
Thank you, Yash. Thank you. It's a pleasure, and thank you for having me and BSR REIT be on the panel. BSR REIT, as you may remember, we are a newer REIT that came onto the company or into the TSX in 2018. And we currently have a market cap of about $700 million. In terms of that includes our B shares, but overall, our enterprise value is about $1.15 billion. And we are located in the mid to lower, it's part of the Sun Belt in the midsection of the United States, primarily Arkansas, Texas, and Oklahoma. We have 1 property left in Mississippi, and we have about 8,400 apartment suites that we own and manage. And if you remember BSR REIT, one of the secret sauces in our company is that when we went public with an internalized management platform. And today, we've been in business since 1956, and we have been managing our own assets and have carried with us a culture and people of doing it the BSR way, which is extremely important. And we do certainly believe in the people being our secret sauce and why we continue to see such room and growth in our company.
Okay, Curt?
Thanks, Yash. And thank you for inviting us to the panel today. InterRent REIT has been around sort of in the current form since late 09, early 2010. It was formed back in 06, 07 with a major event happening in 09, 010 that resulted in sort of a shift of focus from external to internal and a shift in management team. Over the last 10 and a half, 11 years that I've been part of this team, we've grown significantly from 4,000 units to now just under 12,000 units. And we are now in Ontario, Quebec, and Vancouver, which is those 3 markets represent about 75% of the apartment universe and population in Canada. So sort of focusing on those major markets has been our strategy up to date. We have done that sort of with our company values of quality, integrity, strong commitment to our teams and our communities, respect for our environment and our communities, our team, and all of our stakeholders, and a service excellence. And the company has primarily been focused on repositioning assets and taking assets that have been maybe either run down or neglected by owners and repositioning them so that they are now part of the vibrant community, and not going into a point where they remove assets from the stock of housing, but actually add to the stock of housing by extending their useful life. We are now, like I said, in all 3 provinces, focusing on 12,000 suites and continuing to grow.
Phil?
Thank you, Yash, and good morning to everyone. Killam REIT, we started life as a public company in 2002. We were a corp then. We went public, we were internalized, and we owned $10 million of assets in 143 units. Today, we are $3.8 billion in assets, 17,000 plus apartment units, a portfolio of manufactured home community assets, roughly about 6,000 units, and a small commercial portfolio that really is nothing more than future land banking for our development side of the apartment business. So that really is a quick summary of who we are, and I'll turn it back to you, Yash.
Okay, thank you. Now, I'm going to ask a general question. How are you positioning yourself if this pandemic lasts for the rest of 2021? And what are some things you learned over the last 1 year, and how you are implementing those things in your business now? So, Curt, do you want to start with your answer? I think you're on mute, Curt.
Sorry, I guess that's the pandemic phrase that's been the most used in the last year is "you're on mute." So over what we've sort of learned, if you will, from the pandemic and what happens if this lasts through 2021, I think for us, I'll answer that second piece first, is we've taken the belief that what's happened in the market has not been a structural change. It's not like there's been a lack of demand to come into the country that's resulting from the country becoming unstable or less desirable. In fact, in a recent BCG poll or survey that was done, Canada for the first time has moved into first place ahead of the US as far as desirability for foreign people to immigrate to. So it continues to show that there is a demand for immigration into the country, both from permanent residents, people wanting to move here, and from students. So we've taken the position that, this is not a structural shift in demand for our stock. It's a pause button. And as a result of that, we have decided to sort of stay our course in what we do and how we run our business, which has meant an increase in vacancy. If this lasts through 2021 and doesn't look like it's going to get better, we may have to, re-examine that position. But at this point, given that it's now sort of more hopeful in the sense that shift back a year ago, we didn't know when and if a vaccine would be available. Now we know it's available. It's a matter of how fast can we roll it out. So I think that the philosophy that we have is going to prove through, and we'll hold the course through the beginning half of this year and through the later half of this year as we see everything come back in line. Our thesis will hopefully prove out. As far as what we've learned, I think a couple of things. One is it's allowed, I think, many of us to reconnect with our residents. It's given us the opportunities to slow down a little bit and have some discussions with them about what's important, about health, about safety, and so many other topics to both improve their life and also have us learn more about, what is going to be drivers of future demand from these people and from our tenant base. The second thing is adoption of technology. I mean, real estate sector in general has been slow to adopt technology. And I think even though I believe fundamentally we were pretty much at the front of the industry when it comes to doing that, as many of our public peers have been, this has sort of pushed that adoption of technology, both from the resident side, as far as how we communicate with them and how we interact and what services are available, but also on our own company side. When you're rolling out these new technologies, as anyone knows, when you're trying to roll something out on mass scale, change management's a big part of it. And COVID has actually accelerated that adoption. And in many ways, it's not really changed things fundamentally, but it's accelerated trends that were already there. So for us, the continued usage of the cloud, continued usage of things like Teams, which we had rolled out just prior to the pandemic, are onto our second version of our CRM, our second version of our BI tool. It's accelerated the adoption of these technologies by all of our stakeholders internally, because it's no longer a point where they can be in the office and ask someone to give them a copy or print something out or do something. So I think that's been the other real big benefit for us.
Phil?
Well, I think I'll start by saying coming into 2020, the beginning of 2020, I would have said that the fundamentals for the multifamily sector in Canada had never looked better. They were so strong. I mean, really, the big drivers were a job creation rate across the country and an increase in population. A lot of that due to the high levels of immigration. So with that combination, we were looking at it in terms of the ability to have all our apartments full, be able to put in reasonable rent increases throughout the portfolio. It was, we were hitting on all cylinders. COVID hits, you know what? There's more than a pause. It was quite a scramble in the beginning in terms of what was going to happen, because there was a lot of unknowns throughout all of last year. And, the year kind of ended basically with the first approval of the first vaccines, which gave everybody a lot of sort of optimism. Now we're already finished the first quarter. We're basically, and depending on what province you're in, there's other additional lockdowns. It's not all completely the same throughout the country. And really the expectation is we're going to be in some sort of lockdown state of emergency for at least another 3 to 6 months right across a lot of the provinces that we operate in. So what have we learned, or where's the opportunity? The opportunity is there, just like it was a year ago, when things start to open up from the ability to travel and the ability to bring in new Canadians. I mean, that's going to be very positive, and eventually get everybody back to work. Now, will everybody go back to 5 days of the week, back into their office environment? I hope so, but maybe the answer is probably some sort of combination of work at home and work in the office environment. From the adapting to the changes, we were set up nicely for it before. We've been early adapters, and our operating platform was there, and was already it was there to take advantage of this sort of change. And we have basically, it's been seamless for us to be able to work remote from all our different locations. So looking at what's our expectations of the apartment sector in the next 3 or 4 quarters in the next year, we already see sort of in the provinces that have low COVID-19 numbers, the leasing activity has basically come back. Obviously, Ontario with this additional lockdown will hurt the leasing activity for the next month to 2 months, but overall, we're quite comfortable and very confident that everything will sort of come back to a more normal by the end of this year.
Okay, John?
Thank you, Yash. We were located in the mid-south part of the United States, and there is a a difference in the culture, but the people are all the same. But I'd like to invite our audience to, it's been a different dynamic with how the COVID has I guess it morphed through this different period of time. In terms of how states, there's 50 states, and each state has a way to relegate and to be able to migrate through how they were going to address the COVID-19. And in particular, for the states that we are operating, it's been a little bit more of a proactive and a pro-business way of an approach. And what we've been experiencing in our markets in general has been a little bit more of a vibrant business activity. But let me come back here a little bit more so to talk about what BSR REIT initiated back in early 2019, was to go from, we were located in 17 different markets in this part of the country, including Louisiana and Mississippi. And today we're residing in 7. And as we complete what we had done and decided to do, is that there was a massive amount of cap rate compression that we saw in our secondary markets where we were currently, where we had been located for many, many years and had seen a nice level of growth. And we had made a tremendous amount of investment into the properties that we owned. So we wanted to take advantage of both the opportunity of the cap rate compression compared to the primary markets and rotate that capital over into the primary markets. And that's exactly what we've been doing and what we've about to have accomplished through this tremendous amount of rotation that we've been executing upon over the last 2 years. We've we have bought $880 million worth of properties that are located in Dallas, Fort Worth, Houston, and Austin, Texas, which are primary markets, and they are the highest growth markets in the United States over this last 12 months. They're all forecast by Reese, CoStar to be in the top 10 markets in the United States over the next 5 years. And when you think about what we've done physically in terms of a repositioning, no one could have said about what happened with COVID, and no one would have wanted it. But from the way that we have repositioned our portfolio in terms of putting the greatest exposure into the markets where people are moving from around all across the country, where in Texas, the renter migration growth that they were experiencing, 50% of the renter migration growth are college educated. So it really tells you that this is a decision that's being made by the renters coming in from Oklahoma or from New York, New Jersey, and Oklahoma and California. And that is what we've been seeing on our rent applications is a tremendous amount of people moving in from those markets in particular. But in terms of being our location today, we've got 95% of our NOI exposure into these markets. And we love the markets because we've seen how the growth that has been transpiring for the last 50 years in watching Texas grow. Every 20 years, when you look at the city of Austin in particular, we were there just yesterday. And in Austin, every 20 years, the population has proven to double. The state of Texas is about 34 million people. They're expected to have 55 million people in 20 years. And this is not just 1 or 2. This is the forecast for the state of Texas because of Texas being a state that is very business friendly, very low regulatory controls, and as well as having the lowest state tax, being 0 for a state tax. So we wanted to position our company knowing that these markets in particular are drivers of business growth and renter migration growth and economic growth. And we certainly foresee a tremendous amount of revenue growth as we're looking into 2022 going forward for the next 4 years. 22 is forecast in general for these 3 markets combined at revenue growth a little bit north of 6%. And how you might want to translate that into your ultimate share metrics. You know, your NOI, if we're about our 53%, 54% of our interest margin would end up being going to the bottom line, and then again you could double that by going into your AFFO, and that's exactly what we're expecting. In terms of our technology, fortunately for BSR, we have challenged our IT department, and we've been working on it steadily. We did not miss a beat as we went into this past year. We've always been collecting at least 98% early going of all of our billings, and we've had our traffic was about the same, if not a little bit better, but it was all virtual traffic for the most part early going. And today, what we have is about 38% of our traffic is being done virtually in terms of the leases that we're doing online, as well as the virtual property tours. And it's amazing. The business has changed, and as Curt said, maybe this has gone a little faster for all of us. We were behind the curve in thinking that we just wanted to have it available for those that were using the internet and the technology. But what we've really found is that we all are able to now utilize, but also exploit the opportunity of what we are seeing in terms of presenting a way of changing our business and migrating it into a more of an internet-related world where people live in a physical apartment that allows for a little bit greater efficiencies that we will see going forward with how many people perhaps that we are going to be needing on all of our properties. It'll be about a 2 to 3% more efficient way to operate from a standpoint of people that we see from a standpoint of how that may affect our bottom line there.
Thank you, John. Now the next question is for Killam and InterRent. It's more Canadian specific. The pandemic has caused a sharp decline in demand from new immigrants, students, and young professionals. Now, with the increased immigration quota announced by the government and a potential bounce back in demand once the pandemic is over from students and young professionals, how are you positioning your portfolio to take advantage of that opportunity? Are you doing something different, or are you saying that our portfolio will benefit like the rest of the market? Curt?
I remember to unmute myself this time. Sure, I can give it a shot and then add some color to it if you like. I think what we're seeing happen, like student visas alone, for instance, foreign students, there was 108,000 less foreign students in Canada at the end of December 2020 compared to December 2019. So, that's a significant impact. And the bulk of those students end up in Ontario, British Columbia, and Quebec. Those are the sort of the three top places they go, and those markets get hit significantly, and those are our markets. So we've definitely seen the impact from that. And then on an immigration standpoint, we were going from where as Canada as a population 2015 to 2017, 18, we had about 290, 300,000 new immigrants coming in. And we saw that really climb 320,000 in 2018, 340,000 in 2019. And the government targets that you alluded to are over 400,000 for 2021, 22, and 23, which is significant. I don't know if we'll hit that in 2021, quite frankly, given sort of some of the delays that we're seeing, but I think it's definitely coming back and trending in the right direction. What we've continued to do is continue to prep both our repositioning program, so continuing to get everything ready, continuing the suite turnovers, continuing the lobbies, and we've continued to also focus that everything can be done online. So right from leasing application, before that, viewing the apartments, we've got pretty much all of our portfolio now on that you can do a 3D tour on. So not just pictures on a website, but actually walk through and do a 3D tour of the apartment. You can do 100% of your application right through to lease signing, deposits, all online. And that's just to help people get everything organized before they get into the country and to make it as efficient and as easy as possible. So, I mean, for us, it's keeping our rates there, having availability through our occupancy numbers, continuing on with our repositioning programs, continuing on with pushing through all the automation pieces, and getting ready for what we believe is going to be a very strong middle summer through the fall.
Okay, Phil?
So, thank you. Yes, just refresh my memory again about the question, exactly what you're asking.
So, you know, there is that expectation that demand is, rental demand is going to come back, especially for apartment properties in a big way once, you know, the immigration is open and schools and colleges, universities open. You're going to see a big increase in the demand for apartment properties. Are you doing anything to absorb as much as possible of that demand, or are you of the view that you will absorb what the, you know, at an average rate, or are you taking any particular steps?
Well, I think to answer that question, we all would have experienced a slight decrease in our overall occupancy by the end of last year. And that was, again, there's always a lag effect in terms of these huge factors that influence the overall demand and the actual occupancy rate of your portfolio. So we were very strong in the first quarter, and it sort of tapered off for the next three. Since the end of the year, we've actually seen it start to pick up right across the board. And there is a correlation, again, with the provinces that have the lower COVID-19 counts, meaning that there's more people willing to come look at your unit. And again, obviously, we would have a platform that you can do everything from start to finish online. And we've noticed increase in applications from international sort of students that are looking at the number of different markets that we're in terms of expecting to be able to go back to in-class university education, plus being able to come into the country. So with that, the overall question is that you're asking is that there's really nothing has changed in terms of our thinking about being ready. We are ready for this sort of increase in demand, and we see it province by province. And, you know, as another example, with the additional lockdown of the Ontario market, we fully expect that our level of leasing activity will slow down for the next 2 or 3 weeks until that gets sort of lifted again.
Thank you for that, Phil. Now, John, this is specific to your company. You know, you have materially changed your portfolio since you came public in 2018. And it almost looks like a different portfolio now. What is the next stage for your company? Where do you plan to go from here?
You're exactly right, Yash. We have made a tremendous transformation of our company, trying to take advantage, and we have taken advantage of that market dynamic I previously spoke to about the cap rate compression in the secondary markets and going into the primary. And, you know, in the past, you know, before when we went public, we may have been more noted as being a value add type of a company, taking advantage of the opportunities. And now that we transitioned, the way I would, you know, frame BSR as opportunistic. Instead of being put into a certain pigeonhole of a box, we're going to take advantage of market opportunities where we know that we are looking at the long-term value of our investors and doing everything that we can to continue to build onto that. So where's the value component where we saw a tremendous opportunity was consistent, steady, low risk growth that we were going to experience prior to COVID. And now that we've been buying properties even through the pandemic that we were able to execute upon, we've now got 95% of our portfolio NOI that is currently in Dallas, Fort Worth, Austin, and Houston. And where we are seeing from all the different metrics is exactly what we had been doing our homework and our study of why we wanted to be in these markets. is because of the outsized growth. And what's really the great dynamic that's going to help ensure that this is going to happen, at least for the near term. I think all of us have seen what's been going on with the commodity pricing. You've seen lumber on the per metric ton going over, or per ton going over $1,000 per board foot. And you've seen, and that's going from about $250 US dollars. And you've seen all the other costs of the construct for construction costs going higher, plus the wages that have been going up. So it's really a pretty good dynamic for apartment ownership in the near term in our markets. Not only are they forecasting when the pandemic is coming out that the people, there's going to be a nice, wonderful ramp up in business activity and growth in our renter migration, but also from a standpoint on the other side of it, the supply should be at least mitigated because of the higher costs. And so, when you put in our portfolio, I don't want to say it's all new, but let's just, when we went public, we were at an average age of 29 years. And today we're at 15 years. We dramatically rotated the properties into much newer, more meaningful type of amenities that the younger cohort, that is the cohort that we aspire to have, which is a middle income cohort that has been coming into our communities. Over half of them are millennials. And that's been a wonderful asset for us. But we're also now getting into what you might be looking into, smart technology that we're putting into if you want to say the overall dynamic of an opportunity for our cohort to be able to utilize, so that's just another little realm of opportunity for income growth that we hadn't been doing in the past. And we're starting to incorporate that. You'll hear more about that as we roll this out. So that is going to be a real additive to, on top of the economic and the other growth that we're seeing in our markets.
Okay. Now, I would like to focus on this chart that I'm sharing. And I would like you guys to explain what your FFO growth has been, why it has been like that, and what do you plan, or what do you expect it to be over the next 3 to 5 years? So maybe we can start with Curt.
I'm going to start taking it personally, Ash, if you keep calling me out first. I don't know what I did to get on your bad side here, but we're going to have to talk about this after. Sure, happy to. InterRent's sort of historical FFO growth on a per unit basis. If you sort of factor out last year, sort of, I'll pull 2020 out because I think your numbers that you're showing up on the screen right now, Yash, factor in 2020. And I think if you sort of pull that out, we've sort of been north of 8% for most time frames. Our decision in 2020, as I mentioned earlier, was to hold on rents and hold on certain levels, which meant our occupancy declined fairly significantly in some markets. And of course, that has an impact on FFO because that just flows right down to that FFO line. So if you sort of factor out the increased occupancy and you normalize our occupancy for 2020 and some of those extraneous COVID costs, I think you end up in the high 7s, low 8s also for the FFO on the CAGR number that you're looking at on the screen. We don't provide future guidance, but I think consensus calls for us to be in and around that sort of mid 7 to mid 8 number looking out the next couple of years. And I don't have any problem with what consensus has out there.
Okay, Phil?
Again, Yash, can you just kind of explain exactly what's in this graph from your point of view?
So what that, so your line is the dotted blue line. What this shows is how your FFO per unit has grown over the last, since your inception, since you came public. And at the bottom, those two bands, they show your compounded annual growth rate over the last 5 years as well as since inception. And Killam's growth rate has been about 5% per year for the last 5 years. And since inception, it is like one of the highest, 18%. So just maybe you can talk about, how you were able to achieve that, and what is your expectation over the next 3 to 5 years, where you think growth will come from?
Yeah, I mean, our growth, and again, when I say growth, it really is, our focus is on FFO, is what your graph is trying to get at. And that is looking at, if you have assets, how do you improve them? How do you increase the top line, which is the same store revenue that a lot of investors are focused on? That, what does that really mean if it's not dropping anything to the bottom line? So it's how do you control your expense? How do you control your G&A line? And what's your cost of debt and what's your leverage? So that, especially in the last number of years, we've been consistently showing growth at the FFO level. And a lot of that has to do with our development program that we started over 10 years ago. And for anyone that wants to get into it in a big way, it takes a number of years to basically land assembly the locations, pay for that up front, which is, again, is not producing any income. So you basically got to have it. And then you go into the development program, and it's about 18 months to 2 years to actually produce an asset. But once you do that, they are very accretive. They do drop a lot to the bottom line because the money has been spent probably a year or 2 years previous. And that is really helping our growth on a year-over-year basis.
Okay. And do you think that will your development program will be a material contributor to your growth going forward also?
Yes, because again, we got what we have in the ground today, what will be coming, what we'll be finishing up this year and next year, and what we're starting probably in the next 6 to 12 months. Well, it's a constant sort of in and out. But every time we finish one, it's all right to the bottom line. And, basically, I believe that we're not really getting the credit that we deserve in terms of the growth based on our development program.
Right. John, you have a relatively short history on that chart, but you can, if you want to take that question, go ahead.
Well, I'd love to, because the chart certainly indicates a little bit of a backup of the FFO. But, we had told the markets that we were going to be rotating and taking advantage of an opportunity to rotate out of the secondary markets and take that capital into the primary. And when we did that, we sold the assets for 10% more than what we put into the IPO for. So when you think about the composition of value, that's exactly what we did. And we did this for the reason that now what we are looking for is to have steady, consistent, outsized growth than what we would have otherwise had. And knowing that on a 3-year look back, we're going to have positioned the company to continue to experience an outsized growth of where we would have been. And in particular, for the next several years, we are looking forward to an outsized growth of our FFO and AFFO over, just given what I had previously talked about, the growth in these markets and why we did what we did. So it was a very thoughtful approach of what we were looking to aspire for our shareholder, that it wasn't looking to make sure that we would be growing FFO as we are in the midst of a noisy rotation opportunity that the company took for our shareholders. And we're very excited about thinking that it's going to be, I hate giving a forecast. I did do the expectation of what the revenue increase for the 3 markets that were positioned is a little bit over 6%. And with that said, you could bring it down all the way down into the share metrics. And I won't say that it was a double and a double. I would say that we are certainly looking at what we had done to be double digit, in the low double digits for our FFO and AFFO growth, for how we would, conservatively come out to talk about these metrics.
Thank you, John. Now I want to talk about the acquisition environment and cap rates. all three of you were quite active for the last 12 months in the acquisition market. So I just want to understand what your expectation is about, you know, the acquisition environment in your markets over the next 1 to 2 years. I don't want to upset Curt anymore. So maybe Phil, you can start off.
Well, I'll start off probably the way I've sort of phrased it over the last 15 years. There is still cap rate compression in a number of the markets. And there are certain markets that you get a little bit better or going in cap rate than others. But the big ones, the Ontario, GTA, and the Vancouver, you're really looking at 3 to maybe 2.75 cap rates today. And from our point of view, the problem with that is, I mean, you're doing that if it's an existing property. And you can do it depending on your base, how large you are. You can absorb 1 or 2 of those. I think, again, this is from my point of view, deals. If you see upside, and again, you know, it's your own opinion on an individual asset, that can you turn it around? Is it below market, the rents? And over time, it will become creative and it will be a good investment. The hard part of our business today, it's so competitive, and a lot of the opportunities are in small portfolios, whether they're 300 to 800 units or 1,000 units, and they're into the multiple hundreds of millions of dollars. And if you're prepared to do that, then I think you're prepared to basically give up real growth in FFO earnings in the short term, because it's a pretty hard hurdle to sort of overcome and show real growth on a year-by-year basis. And so today, the environment, it's never been more competitive right across the board. And I don't see anything changing in the next 12 to 24 months.
Okay, Curt, are you ready now?
Sure. And don't worry, Yash, I can never be mad at you. You're too nice of a guy for me to stay mad. I agree with Phil. I think, look, in all the markets, you're seeing the spread between cap rates and the bond is actually healthy right now. It's not, you know, too squeezed or too far out of whack. So there's no real pressure there for it to move. And then you turn around and look at the amount of desire there is to own private assets, and what the appetite is there, the wall of capital, as people speak to, coming into the sector for both multifamily and industrial. So there's a lot of demand for the product. Personally, I think you're going to see cap rates probably continue to compress a little bit over the next little while. I'm not talking, you know, 50 basis points or 100 basis points, but I do think somewhere between 0 and 25, you'll continue to see compression in most markets. You look at the markets that, if you take a look at sort of historical immigration patterns, and you look at what cities they're going into, most of them show that the immigration going into those cities is higher than the cities are as a percent of population, meaning that those cities are going to continue to outgrow, and outgrow means demand for housing. So you sort of take a look at those patterns, you can see what cities that you know, that continues to happen to. So I think cap rates will stay tight and stay compressed, and potentially compress a little bit further. And I agree with Phil's point he made about, you know, when you're doing certain things in that market, whether it's repositioning, which we tend to do a lot of, or new builds, which Phil tends to do a lot of, those things have a short-term impact on your FFO. They have a short-term impact on many factors. And, you know, if you look at both of us, when we do those things, whether it's repositioning or a new build, you'll see sort of some pressure on that FFO curve, if you will, and then you'll see a hockey stick as they come online, and they'll grow up. And when you look at our FFO per unit over the last, from 2009, when we transitioned to now, it's north of 20% when you look at it on the whole basis. But if you take it and go granular onto any given year, it's very lumpy because of exactly what, you know, what Phil mentioned, and you're getting into those strategies. For us, the cap rates going in, I agree with Phil's, again, numbers around that 2.75-3 in major cities. We tend not to get too fussed about going in cap rates, because we tend to take our own view on what that asset could look like in 3 to 5 years. and what it means sort of when you get to that point. So, going in plus all the CapEx that you need to do to turn it around, what does it look like in 3 to 5 years? And I think, even at these low cap rates, given the supply demand imbalance and given the push on rents, they still make for very good investments. And, when you look at what's happening in the private market and what the cap rates are there compared to what you're seeing for cap rates in the public market for ourselves and our peers on this panel and across the industry, there's definitely a disconnect, and there's definitely a lot of value pent up there, I think, with all of us.
Okay, thank you for that. Good. John.
Well, I totally agree with both Phil and Curt. There's definitely been even in our markets in Houston, Dallas, Fort Worth, and Austin, that we've seen a run down in cap rates, and maybe there is a little bit more room for them to continue to move down as the anticipation of coming out of the pandemic has been driving a large demand to be positioned and ready to take advantage of the growth. And we understand that, but BSR, we're very sensitive to our cost of capital. And we've been in these markets for 30 plus years, and we know the players. We like doing deals with off-market deals with same store or same sellers, and that has proved to be a positive experience for us, our investors, and we have at least been able to take advantage of the opportunities. So when we think about where our price of our stock being traded, where our NAV had been where it was 12 or 6 months ago, even, is a completely different story in regard to where we see our NAV being. We're trading about a 16% discount of where we see where our NAV is. And it's a tremendous opportunity, and becomes of the disconnect that Curt just mentioned, to be involved in having an opportunity to be a part of that, a part of the story if someone wanted to be in these high growth markets. And it's just, for us, the cap rates will always be a part of where we see in our underwriting of being conservative with it against where our growth would be for the opportunity going forward. And I've talked about that in regard to what we had seen in our share metric of FFO and AFFO. And we were strongly confident that we were going to be in that category in these next several years.
Okay, thank you, John. Now we'll see if the audience has any questions. Nishita, do we have any questions from the audience?
Yash, there are no questions as of now.
Okay, so now is the good time to then call this session to an end. On behalf of Laurentian Bank Securities, I would like to thank all of you for participating in our conference, especially the panelists. Thank you very much for taking the time, and have a good weekend.
Thank you, Yash.
Take care.
Phil, Curt, thank you.
Thank you, everyone. Appreciate it.
Goodbye.
All right. So, Nishita, how did it go?